Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope I am audible to you. Good day to everyone. Thanks, Maud. Thanks for confirming it. Let me display the PowerPoint presentation tracking the forex market together, part 2 on March 30th between 13 and 13:45 GMT. We will track the market using the live market code page and also use the specific trading strategies similar to what I explained during the part 1 and try to see how exactly we can earn consistently from that of the market. So to track the market, we use the live market code page. I'll also give the link for the live market code page. I'll focus the camera over there of the live market code page. Now currently Euro is trading around 1.3338, 1.3340, and you know that Euro went up slowly from that of mid-European session up to that of 3368 and then started making the slide again to that of the original level what we have seen during the first part of the webinar. And GBP has gone up to 60.10 and 60.30, and 60.33 was the high, and they breached the high by about 4 pips and came down again during the start of the gap time. And USD they just came down around that of 82 level and firmed up around 20 pips, and now currently trading around 22.19, 22.21. And USD CHF has just made about 3 pips dip to form new low 9009 and then holding it, and CHF is showing 34 pips negative net change when Euro is showing 39 pips positive net change. So as I explained that they are not willing to drop USD CHF more, and as we have seen during that of the European session that they are handling the crosses nominally, you find the positive net change in the case of USD CAD as well as US Australian dollar. So not much of activity is happening in the market even though it is a weekend. Friday, normally during weekend, they tend to make aggressive moves. So we will try to learn about our basic trading strategy and then I'll come back to that of the live market code page. So after opening out the live market code page, we try to identify the various session times. So during the European session, we had done the part 1 around 9 GMT. 1 hour and 30 minutes past the start of the European session, and now it is gap time 13 to 13:30 GMT, and from 13:30 to 13:45 we'll have that webinar, and that will be 15 minutes of the US session. So after the starting of the daylight saving system, you find that the market time is slightly advanced with regard to US session by 1 hour and European session by 30 minutes. So these timings are all followed by the other players. So we try to, based on the natural occurrence of the bank opening and the closing, so the same timings we will also follow. Now with regard to the trading strategy, first of all we have to identify what are the type of moves they are doing it using the live market code page. Then subsequently identify the type of moves they are making in the market from time to time. Then from there we derive what could be the next type of move they could make. Then accordingly we take trading decisions. So for that we note down the initial lows and the highs around 3:30 GMT that I have shown it during that of the part 1 of the webinar, and also you find the net change in the live market code page. That is nothing but the indication of the current market condition or current market level compared to that of yesterday US session close. So around about 15 hours back, what level it has closed, the market has closed, and currently what is the scenario of the market, we are able to understand from that of the net changes. For example, net change in the case of Euro is 40 pips. If you open the live market code page, you will be able to see that 40 pips positive net change. That is why it's shown in green. Probably I'll back that off the live market code page and show it to you. So that means yesterday Euro has closed around 1.3301. From there, 42 pips it has gained. It has come to 1.3343. USDN has dropped about 27 pips. That means yesterday it has closed 27 pips higher than that of the current level. And GBP has closed yesterday 49 pips below that of the current level. That is what it refers to. So you do come across the intraday moves, even though the market appears to be a continuous market. On a daily basis, you come across the initial high and the initial lows are being set, and afterwards the closing level is also being determined. From there, the net changes are given. So in this, the banks have got the restrictions of gaining or losing about 150 pips in the case of Euro, about 250 pips in the case of GBP. They are all the levels up to which they can either rise or drop in the market. But when they have the potential to rise or the drop, they don't simply make either way move. They try to create the market sentiment and act against that of the traders. So they make the bearish move or a bullish move, whatever it is, and just reverse the market afterwards. So that is how they are able to quickly trap the traders to, when they are predominantly short sellers, they gain the levels and induce them to do the short covering. If the traders are predominantly long holders, they drop the market and induce them to liquidate the long positions. And this is what you come across on a weekly basis. And that is what we try to identify, whether they have the intention to drop the market or rise the market. Accordingly, we take trading decisions. So I'll go back to that of the PowerPoint presentation. So once we note down the initial lows and the highs and also the net change, we try to compare the lows and the highs which are formed during the different sessions. See, currently Euro is showing the high of 1.3375 that has formed during early part of European session. Still it has not breached. At the same time, the low is also not breached. Where in the case of GBP, they breached the low what they have formed during the early part of the European session, 1.6033. They breached it and formed a new high, 1.6037. So we identify after 2 hours they breached the high in the case of GBP. That indicate that they wanted to make an intentional move on the upside, even though they are holding Euro at a lower level and not dropping it really, and simply holding it in a range bound way. Why? Because they wanted to drop Euro GBP. If you go to that of the live market code page, you'll be able to see how exactly Euro GBP has come down. So Euro is showing 44 pips positive net change, GBP is showing 49 pips positive net change. And when you refer to that of Euro GBP, it was around 83.55 during that of the European session. It has come down to 83.38. A nominal positive net change is seen towards close of the European session. They showed about 8 pips negative net change. From there, they gained about 10 pips in order to drop further down Euro GBP. So in order to drop or rise the crosses, they handle the majors by making contrarian moves in the case of the majors. Like now Canadian dollar is showing positive net change, Australian dollar is showing positive net change. That means even though it is the gap time, they are focusing on handling the crosses. That is how from time to time we try to read the market, identifying the type of moves they are trying to do it, and then take the trading decisions. So when the market is very active, when the market is near that of the low, we try to take the buy. When it is not breached the low level, or near that of the high, we take the sell position when the high is not been breached for 30 minutes in our observation. When the market is in the middle level, we just relax. Now, the majors are active during that of the early and the late part of the sessions, and the crosses are active during that of the mid sessions. And we know that the gap times, they make the false move. And I explained what is the gap time. You come across now 13 to 13:30 is the gap time before the start of the US session. Similarly, 7 to 7:30 is the gap time before the start of the European session, and 20:30 to 0030 GMT before the start of the next day Japanese session. So this is gap time, and during gap times we predominantly see the false moves. So when you understand that they make the false move, false move is the one, they go up to that of the initial high or low and reverse in less than 30 minutes. And that is what referred as a false move. So now let us see whether they are going closer to the low or closer to the high to make the false move. Sometimes what happens when the volume is relatively less, they just simply hold it, especially during trend reversal time or the last week and the first week of the month. And this is the last week of the month of March, so they may not do it on a daily basis, the false move during the gap time. Instead, they may straight away make the intentional move after the closing of the European session. So we have to watch what sort of moves they intend to make it. And I explained during that part 1 the different types of moves. Less than 30 minutes, they are doing two types of move. One is stop and they go above that of the initial high and come down in less than 30 minutes, or go below that of the low and come above that of the initial low in less than 30 minutes. That they do it during session start and the session close time. Then false move is a one, they do it before the commencement of the extended move. From that of the high, they go up to that of the low without breaching the low. They come up and breach the high and stay above there for 30 minutes. When the data is released, they simply make an upward move. And that is referred as an extended move. And a false move is a precursor of the extended move. So during the data release time, when they make a downward move, understand after the data, they wanted to make a rise. And during the data, before the data release, if they rise, Euro or GBP, understand after the data release, they wanted to drop. You need not even know what is going to be the outcome of the data, and you can see that how exactly they make the moves. And they may drop that market, say for example, Euro, when US data is positive. When US data is positive, they make a drop in the case of Euro and simply call it as the USD gaining move. On certain other occasions, if their intention is to rise Euro, the US data might be positive and all will expect, because last time they had dropped when US data was positive, Euro, they had dropped. So this time you might expect that USD gaining move could happen. They simply rise Euro and say it is risk appetite move. So whatever be the data, they can give different type of interpretations, and ultimately they are all nothing but the attributes. And these attributes stay only for a few hours. When the next data is released, then the previous data release is being forgotten. Market has got a very short memory. The traders also have the short memory, and they just look into that of the new data in a tensed way. And once the data is out, their market might react, and the traders might say, let the market settle, then later on I'll take the position. The market might settle when all others will be waiting and looking for the next data release. In the process, what happened? The volume in the market has dwindled, and that is why you find subdued moves are happening even on a Friday like this. Then when they make a move slowly and continue to cut the high every 30 minutes to 1 hour, or continue to cut the low every 30 minutes to 1 hour, then it is the intentional move. These are nothing but the names simply to differentiate the moves, but you can use any sort of name for that matter, and identify the moves are based on the time frame. And once you understand that they are all based on the time frame, then you will be able to focus on the timings of the market, and then you will find the importance of following the live market port page to track the market at ease. Now, I forgot to mention about the first slide. Okay. So I said before closing of part 1 that I will try to explain to you the gap time trade and also the high-low, what they are set. I explained that the high and the low, the high in the case of Euro, they are not breached. Only in the case of GBP, they are breached, indicating that they wanted to make a rise intentional move. Now you come across a dip in the case of GBP. It is a gap time dip. Around, see, from 13 to 13:30 GMT is the gap time, and now it is close to 13:15. They are making a dip in the case of GBP below that of the psychological level 1.6000, 1.599598 are the current levels, and they are not still breached the low or the high. And let us see where they stop it and try to take a buy position. And I will also review the earlier trade. So this is what I placed on order, 33.33. When the market came down and just 10 pips below, I kept a buy order that was not filled in the case of euro. Then I modified the order after about 30 minutes and I took a buy around 33.45. When I know that they do not want to drop the market, and during a small dip, I took a buy and kept the hedging order correspondingly 30 pips below. Just modified it to that of 33.15. And then subsequently, they gained around 12.45 GMT. They went up to 33.68 and stalled. And so I just closed it around using a trailing stop, 33.63 with a 18 pips profit. So that is the only thing. And GBP, I kept a buy order around 59.85. They are not filled it. And so I just, when the order was not filled and already the market has gone above 61.10, I did not take a buy position because I know very well they will try to give another trading opportunity during the next session. And then near the low, I will try to take a buy position. And so that order was not filled. This is the only trade I was able to do it. Even though it is a Friday, I was not in a position to take a good profit. Now, coming to that of the trades, what I have been explaining it. So normally during the sessions, early and the late sessions, they handle the majors and the crosses are handled during that of the mid sessions and also during gap time on certain occasions. I explained the type of moves, and in the event if the market can suddenly reverse against us, then we need to have a contingency plan rather than crisis management. For that, I explained that we have to use the hedging order. In US trading platform, the hedging may not be available. Hedging facility in the same currency pair may not be available. So the only option is using a stop. If you do not want to use the stop, then probably what you can do is you can use a currency in which the same currency is on the numerator. Say, for example, Euro USD is a currency in which you are taking a buy position and you wanted to keep 30 pips or 50 pips below the hedging order. You can keep in USD, Euro Yen or Euro CHF, just 30 to 50 pips below that of the market in the respective cross. You can keep a sell limit order and that will act as an entry stop. Entry stop order, you can fill it below the market. So in the event if the market drops, then it will get filled and that position might make profit, and thereby the unlimited erosion of the usable margin will not happen. So we'll be able to limit the risk. If the hedging facility is available, that is the best when you use in the same pair so that we determine 30 pips only the risk we are going to take, and once it is hedged, then we try to handle the hedge, and that I'll explain with the help of the next slide. Then entry is always 30 minutes from the start of the session. We wait, and if they are not breached the low, if the market is closer to that of the low, we try to take a buy position. If it is a new low also, not breached in 30 minutes, after identifying whether it is an extended move or an intentional move, then we try to take a buy position. And if the market is near that of the high or a new high and not breached in first 30 minutes of the US session, after making either extended rise or an intentional rise, we take a sell position and they are expected to reverse the market, and we will try to take swing trade profit. The exit will be exactly closer to that of the low, what I explained in the earlier trade. Suppose you take buy near that of the low and sell will be, or take profit will be closer to that of the high. And still we will use the trailing stop in a profit making position so that we are able to preserve our profit and try to get it either with a minimal profit when the trailing stop is hit, or close it with a limit with a maximum profit. We can move the limit order away from that of the market when the going is good, when the trailing stop is not hit. That way we try to maximize the profit. And so we do not give much importance to that of our emotions, because we always expect the unexpected and use the hedging order in a loss making position and use the trailing stop in a profit making position. So if sudden reactions happen in the market, and we are not caught vulnerably. And So using a trailing stop in a profit-making position, using a hedging order or a trailing hedging order in a loss-making position will always limit your risk and maximize the profit. And also, when the hedging is filled first time, and then you keep another hedging order second time, if they fill the hedging order second time, that means your market reading has gone wrong, but the trading strategy helps you. So instead of 30 minutes afterwards making a reverse, in the first drop and rise, if they hit your hedging and make loss, if you cut the hedging thinking that it is a stop and they continue to drop without going above that of the initial low and come down, then your second hedging might be hit. Then you understand it is an extended move. So you wait for 2 hours instead of 30 minutes and try to close the hedging order either with a profit or with a nominal loss or with stop at entry. Then afterwards, if they continue to hedge for the third time, understand they are making an intentional move. You are doing the wrong trade. So we don't close the hedging. We keep stop at entry, the hedging, and allow the market to drop fully. When they start reversing it, we try to take profit on the hedge side and then trail the hedging order 30 pips below that of the market. We keep and trail it upward till we are able to keep stop at entry in the buy position. This way, we try to handle the hedging. If you are not having the hedging facility in the same pair, still you can use a cross to hedge, and you can do the same type of strategy of trailing the stop and things like that in the cross. But only thing is, if you use a cross for the hedging, then you will be spending 2 times the margin. Suppose the platform is taking about $1,000 for taking one lot of a currency euro, then if you take another sell position in euro yen, then it might take another $1,000. So $2,000 will be the equity you will be spending, but still limit the risk. But if the same currency pair, if you try to hedge it, the platform may not take additional margin for the hedging facility. That will give you a better cushion for that. So you have to understand the limitations in the platform and try to decide upon the quantum of trading accordingly. And always keep in mind that not more than 1 to 2% of your equity is being used for taking positions, and try to close the positions with a profit or with a stop, and only then think of another position. Most of the traders lose their account or become panic and also make distress trades, all due to over trading, nothing more than that. It is a simple concept. It is like, it is over trading. And over trading comes because of the emotions and because of the greed and the panicness alternatively grips you when the market makes fast moves or quick moves. So always understand that you don't exceed your limit with regard to taking position. And if you have taken already 2 positions, if there is a great opportunity of taking third position, don't take it, and tell your mind that, okay, market is going to continuously give trading opportunity. Next time when they drop, I'll take another position. Till such time, I'll handle the current position and book profit or close it with a nominal loss. Then I think of another trade. If you just have that sort of commitment, then you will not incur any margin fear, and also your market fear will go away stage by stage. And finally, you find that you become a fearless trader. And once you become fearless trader, then you will identify the market volatility as a great trading opportunity. And you will try to capture whenever they are making very quick moves in the market. So if you are capable of using the hedging effectively, you can do either way trades by booking profit on the hedging on side and keep another hedging order and trail it until you are able to keep stop at entry in that of the buy position, and trail the trailing stop. Use the trailing stop in the profit making position and keep the limit and book profit on the upside as well. So market has got only 2 ways of moving, one on the downside, another one on the upside. It cannot continuously or perennially drop or continuously or perennially rise. It has to make swings. The volatility is a great trading opportunity. The market is without volatility, like what you see now. For about 1 hour to 2 hours, it is making only 2-3 pips move, then there is no great trading opportunity. So volatility is required. And if you are afraid of the volatility, then you are unfit to trade. So now in the gap time, let us see what sort of trade we can think of. Now we will see GBP trade. In the case of GBP, they have come below that of the psychological level, 1.600. So I'll try to keep 10 pips below that of the market, 1.5990, and try to see whether they are filling it. If they are not filling it, I'll try to modify to the market level and try to take it. And in first 30 minutes of the market, I'll try to book profit. So as soon as we keep the order, we also keep the hedging order, entry stop order, or a stop 30 pips below. 1.5960, 30 pips below, and try to see whether they are filling the buy order. In the case of GBP Euro, they have just gone above after trading around 33.43 and just firmed it up, and also GBP they have firmed it up. But see, I want you to understand the concept more rather than me trading it, because I can just do the trade and show that I made profit. That is not my objective. I want others to learn how exactly the trading can be done. That is why I have just taken more time in explaining it. And the part 1 is also recorded and it is being displayed in FX Street archives. Kindly go through it in case if you are not able to follow my trading pattern and the strategy is a simple trading technique. And if you have got still doubt, you can always ask me through email or messengers. I am willing to answer to those questions, because ultimately as a professor I want the traders to learn and develop their own trading strategies and get rid of the market fear. And other than GBP, which has made a dip, and Euro is making a small dip now, so we'll try to take a buy. I'm just watching the live market quote page, so I request you to open the live market quote page separately and just watch it. And currently 33.46, 33.48. So I'll just keep one buy order, 10 pips below. $1.3336. And these are all nothing but the limit orders. So I don't take any position at market unless and otherwise I get really confirmed that they are not willing to drop for 30 minutes of observation or 2 hours of observation, depending upon the type of moves they are doing it. And once you keep the order, we try to keep the entry stop or the stop 1.3306. So, and these orders are just kept only for about 30 minutes. Once the session starts, if the order is not filled, they are removed, and I wait from 13:30 to 14 GMT. As I explained with the help of the PowerPoint presentation, that up to 30 minutes from the start of the session, I wait. If the market comes closer to low and not breach the low, then I'll try to take the buy. In case if they breach the low, I wait for about 30 minutes to see whether it was a stop hunt on the downside before making a rise. And when they go below that of the initial low or the current level, and then if they don't rise above that in less than 30 minutes, I understand they wanted to make an extended move for 2 hours on the downside. So just wait for 2 hours and then try to watch whether still they are breaching the low. If they are breaching the low, I understand that they are making an entry move on the downside. Then I don't sell after the drop or buy after the rise, and they are all wrong trades, because invariably they induce us to do such trades. We might be doing scalping and things like that, or a small swing trade, but that will change our mindset to chase the market. Once you try to chase the market, you fail to recognize or fail to understand the common logistic. When it is cheap, we try to buy. When it is expensive, we just get rid of it. And so we fail to understand that particular basic concept. We try to chase and buy at the highest level, later on repent that at the highest level we have purchased it, and afterwards it is not going up. So ultimately, our common logistics should always work. The brain has to be alert in thinking about the common logistics while doing the trading. So don't become totally a technical trader. Use your common sense, whether it is worthwhile taking a position and book it when the market is subdued, and just keep away from the market. Taking the position and waiting and praying for the market to go up is one aspect, but that we become tensed, unnecessarily tax ourselves, and we don't earn anything, because we all come to the market only to earn money from the market. And when they are not giving appropriate trading opportunities and making very subdued moves, then keep away the market. And whenever they make quick move, try to grab the great opportunity. That will be the ideal way of trading in the market, so that you don't become addicted to trading. We become an opportunistic trader. So these are all the trades I just thought of. Let me spend more time in explaining the questions which are asked. I'll just minimize the PowerPoint presentation and focus the camera over there of the live market code page and try to answer to the questions which are asked here. Then Jay Khanna, from what you elucidate, you recommend not trading during gap time? No, you can do gap time trading during that other trending time, during second and the third week. Today, the webinar happened to be presented, and it is a month-end time. So obviously, month-end time, they will not make any false move during that other gap time. If at all they make it, it will be very subdued. So I was more interested in explaining the concept because that slot allotted to me, rather than taking a physical trade and explaining it. Hope you are able to understand. You may want to look at Australian dollar CHF, where it has gone down lower than during gap time. See, as far as the crosses are concerned, now looking at the crosses, you find that the crosses can make sometimes good moves, and that could be indicated by that of the majors. See, sometimes the majors might be making the USD gaining move, and the commodity pairs making the USD weakening move. Now, for example, the majors are making USD weakening move. See, Euro is in positive net change, GBP is in positive net change, and Yen is negative net change, CHF is negative net change. That means they are making USD weakening move. Look at Canadian dollar and Australian dollar. They are making USD gaining move. Understand that the first part of the US session, they want to handle the crosses, just earn out of that. Then later on, they come to that of the majors, making big moves. When they do like this, contrarian move, there is no point in taking positions during gap time or during session start time, because we understand that they are handling crosses. When they are handling crosses, when you take position in Euro will be staying there or making only 2-3 pips up and down moves. And by that, we will not be able to earn anything out of that, because it has to make very quick move of 30-40 pips. Only then we can earn. So recognize it using the live market code page. When you look into that of the individual charts of Euro, GBP, etc., you may not be able to understand the cumulatively how they are trying to act on the market. So what currency pairs they are handling at the moment? So they are exclusively handling the cross. Now majors showing USD weakening move, and the commodity pairs making the USD gaining move. As a result, if you see the commodity crosses like Australian dollar, Canadian dollar, Australian dollar, Yen, they will be making quick moves on the downside and the upside, especially the Australian dollar and Canadian dollar crosses. And our friend was referring to Australian dollar CHF. Yeah. So they suddenly made a drop. So this is how, so they would have found that a lot of traders are holding long positions. So quickly they had dropped it in order to hit their stops. So that is how, based on the inside information what they get, they are making the moves in the market. So nothing to do with that of the technicals or the fundamentals. And during the gap time, there is no data release, you know very well. And still they make such moves. And there are so many occasions that traders have asked me the question, there is no data release, why Euro has suddenly gone up? And I told them that A data release is nothing but an excuse, and if they found predominantly of the traders are long or short in the market and they want to squeeze them, they don't require any more data release, and they can simply make such moves, and later on they give in the website and other places there was a rumor. So anything is possible in the market. Okay, they can simply say because of the rumor they have just gained the level so quickly, and immediately people will say that buy on rumor and sell on news and things like that. The news may not happen afterwards. So do you believe this may be the false move? Yes, it is a false move. Then FXB, how many trailing pips do you recommend? See, if it is a very narrow move, then try to use about 15 pips trailing stop. And 10 pips, sometimes they may hit it very quickly because the market swing is normally from the top, the 15 pips to 23 pips. So they may hit it very fast, and you may not have any headway in that particular trade. 15 pips is ideal whenever you are trying to take it and tighten that. And when the position is making really nice profit, about 40, 50 pips and things like that, you can keep 30 pips trailing stop. You can increase the trailing stop width, and still you see that you are getting the minimum profit. Do you recommend hedging with inversely correlated instrument or no inversely correlated instrument? Whenever they make a contrarian move, you will be caught. Say for example, euro, they gained the level. Suppose you have taken a sell in the case of euro around 33.50 and try to take the sell position in the case of USD CHF. No, because when you are just taken sell position in the case of euro for it to drop. No, when euro is trying to drop, you expect it to drop, and then subsequently euro has gone up and it is making loss. So what do you expect when euro is gaining? You expect CHF to drop. So you take a sell position there as a hedging. And when euro might be gaining about 50 pips, CHF may not drop. Then your hedging becomes useless. See, whenever they are not doing the contrarian move, and such trades are possible. But when they are frequently doing contrarian move, that sort of trades are not ideal. Then Sylvester, how about gold? Gold is expected to gain the levels for weekend. That I have been telling during morning and also yesterday during Asian session live market analysis webinar. The same pair hedging is always the best if the facility is available in the platform. Can we get? I will show my email ID and also other contact details. You are welcome to contact. Now I am not promoting the business, and if you want to get any clarification pertaining to my trading strategy and things like that, you can always contact me. Then JD, to handle the crosses, they also have to move the majors. Yes, they make moves in the majors, by that they handle the crosses. They don't move the crosses aggressively. They only move the majors, and thereby the crosses are being affected. And normally in the market, people say that because of the cross action, euro has gone up and things like that. They are all nothing but the excuses. It's also very important to understand the trader psychology. Might have to buy a book on that. See, there are so many books pertaining to human psychology, but especially with regard to trading, and see, everyone will have their individual psychic conditions. So some might become really afraid of the market, and some might nominally afraid of the market. The degree might vary depending upon the individuals. You won't be knowing to which slot you belong to. And so invariably what I request you is, rather than reading all the books, do self-analysis. Whenever you become emotional, just close your eyes and drink some water to dilute the endocrine secretions, and just reflect on yourself. Why you got afraid? Because of the quick moves in the market? If I had not taken the position, would I have reacted similarly? Or because I had taken the position, I am reacting so much? And Why I am reacting so much? Because I have taken more positions, and you will be able to do on your own self-reflection what sort of trade will be ideal for you not to become emotional. We can read so many things, but self-reflection is the best, and that is part of meditation, and there is no need that you need to do a meditation. Just close your eyes and don't think about the market and things like that. Reflect about yourself and your own behavior. And in the heart of heart, you know very well whether you are doing the right thing or the wrong thing. But probably you may substantiate after doing a wrong thing to others that what you have done is correct. But your consciousness will tell you that you have done wrong. So you try to reflect on that. Definitely you will be able to perfect your emotions. It's not difficult at all controlling emotions. And normally out of bad experiences, we learn in the market. Instead, you try to learn from small things what you envisage in the market and also what you perceive in the market, and try to assimilate everything, and you will be able to get a very good reflection of yourself. And the self-study is the best study. It is something like diagnosing your own body. You can go to the doctor, and the doctor does various tests to diagnose you. Ultimately, he asks you the questions. How do you feel about yourself? You say that I'm sick. I feel that I'm having body temperature increased and things like that. I feel dizziness and things like that. Ultimately, unless and otherwise you tell the doctor is not going to complete his diagnosis or his diagnosis. In the same way, you try to reflect on yourself and you become the doctor for yourself. Then FB, do you have anything written up explaining? I have given my trading system webinar in FX Street. In archives you come across that. In fxstreet.net also you come across my trading system webinar series 1 to 10 are being listed. You can listen to that. I explain more about the market psychology there. And I have not written any book because I don't have any commercial mind in just doing it, for the simple reason I want to really explain to people on one-to-one basis or just small groups and things like that. Motivate them to become self-reliance, nothing more than that. Because by God's grace, I have made enough of money. I am not interested in making further money and things like that. Also, the risk reward for this strategy. Okay, when you use 30 pips hedging order, it doesn't mean that reward has to be 100 pips. Let me tell you very honestly. See, the spread you have to identify. The spread between the high and the low in the case of euro is about 75 pips. So the maximum reward you can get is about 75 pips in case you would have taken a buy around 1.33. But currently market is around 1.3344. So in this scenario, the most possibility or likelihood is go up to that of the high. Then afterwards you have to see whether they are going above that of the high or not. So you only take a chance. Still, you cannot keep 5 pips hedging order and say that I am looking for 15 pips, because they will definitely hit your 5 pips. Theoretically, it might be all right risk reward ratio, but practically they will hit your hedging or the stop 100%. So there is no point in that. So any trade for that matter, when they have got the capability of making a swing for about 15 pips to 23 pips, ideal hedging order or the stop will be 30 pips. And we don't keep it as a 50 pips. And risk reward ratio, they are all theoretical. Say, for example, let me just explain, euro has got a potential to go up to 1.35. So I am trying to take a position around 33.43 and keep a stop below that of 33.90. I am taking 50 pips risk and I am expecting 150 pips reward. You can say that. But suddenly they can drop and hit your stop first. And later on may go to 1.35 area, but you don't have a position to book that profit. So in that process, I make about 70 pips loss. So risk reward ratio, always we can talk theoretically. Practically, you just see it in a demo trading platform, understand whether it is meaningful all the time during the market times. Then freebie. If not, would you consider writing something up and posting possibly on FX Street? See, you just go to my profile, Dr. Sivaraman, and I have been giving from 2001 onwards, since commencement of FX Street, the question answer sessions, and unfortunately we have lost the link for all those things. Only from 2005 some of the links are available in FX Street, and they are being listed in under my profile. You can go through that, and there are certain articles which are also displayed in my website, iknowindices.com, and in my blog page I just given certain basic articles. And see, it is not necessarily that you need to read a book of 500 pages to understand perfectly about the market. As the players are not doing sophisticated calculations, why we should do sophisticated calculations to understand them? We try to understand simply by following their strategies. And that particular approach, I just done it for about observation for about 10 to 12 years and found that it's perfectly the similar pattern they are following in all the markets. And those articles are available in my blog, iknowindices.com/blog. You'll come across some of the articles which are listed, and it's free. You can just always go through the articles. If you want to understand any of these concepts, you can always write to me. I am willing to explain to you. So as far as the trade is concerned, it is not filled. Let me go back to the PowerPoint presentation. So as I explained, during that of the gap time in the trend reversal time, or the month end and new month beginning time, they don't really make such gap time false move. That's what's happening now, and they are simply holding the market. And already US session has started, 15 minutes over, and still they are holding the market. And as you see now, then Canadian dollar and Australian dollar are showing the USD gaining more, and the majors are showing USD weakening more. So first part of US session, they wanted to handle the crosses. Later on, they wanted to come to majors. So in that reading and understanding, we do not want to commit our position in the majors. We can only look into that of some of the crosses, wherein we can just identify the moves and take. But already it is time, so I will not be able to look into that of the crosses at the given time. So I take this opportunity to thank FX Street and also you people who have come here to listen to my webinar. And my contact details I have given it, Dr. Sivaraman. Website is iknowindices.com. Email address dr@iknowindices.com. My MSN chat iknowindices@hotmail.com. I am available from 3 to 18 GMT on a daily basis on the market hours. Both the chats, MSN and Yahoo Messengers. You can contact me. Add as a contact my name, and you will be able to contact me easily. I'll accept the contacts. Then my phone numbers also I have given it in case you want to have an urgent talk. You can always call. But the ideal thing will be contact me through chat, because if somebody calls me over phone, there are so many waiting in chat. Please understand that it is better to contact me through chat, so I can spend enough time with you and make you to understand about certain concepts of the market. So I take this opportunity to thank everybody, and see you next week on Monday during Asian Session Live Market Analysis. On a daily basis from Monday to Thursday, I am doing Asian Session Live Market Analysis between 5 and 5:30 GMT. You can attend to this if time permits, and you can understand how I am making the trade setup and giving the calls, and you can see how easy to understand the market. Once you gain the confidence, you gain the money automatically from the market. So thank you one and all. See you on Monday. What time in ISD? We are 5 hours and 30 minutes ahead of GMT. Thank you.